In this lecture, we will be discussing the income tax computation, that how we can calculate income tax liability from the sources of income that is generated by an individual. Let's discuss it further. An individual income can be classified into following three types. First of all, non-saving income. Other is saving income, that is the interest, and third one is the dividend income. You have to follow the sequence. First one is non-saving income, then it's saving income, and then the dividend income. Now, as far as non-saving income is concerned, anything that is not dividend and interest income falls in the definition of non-saving income. In our syllabus, non-saving income might be property income, it might be trading profit, it might be employment income. That means an individual can earn income from any business, being a sole trader or a partnership, in the form of salary and in the form of any rental business. Now, in order to calculate the income tax liability, first of all, understand the format of the income tax liability computation. First, we will consider the non-saving income, then the saving income and the dividend income, and there is a column of total income. List down all the incomes one by one and classify in the relevant column. Now, combine all the income, we get the value of total income, that is total non-saving income, total saving income, and total dividend income. And that is the total income of an individual comprises of all the sources. Then you have to deduct something from it, and that deduction is like if there is any trading losses or some sort of qualifying interest, which we will be discussing later on. And after deduction, the value is known as the net income. So finally, the non-saving net income is 55,000, 10,000 saving net income, and dividend net income is 15,000, and the total net income is 80,000. An individual who is earning income less than 100,000 can claim personal allowance of 11,500 in this tax year, and this is a type of tax-free income. Means up to 11,500 you don't need to pay tax. So after deducting 11,500 from net income, the taxable income is 43,500 non-saving, 10,000 saving, and 15,000 dividend. And finally, the total taxable income after deducting personal allowances is 68,500. From this total value, we will be judging that the person is either the basic rate taxpayer or the higher rate taxpayer or the additional rate taxpayer. These income tax rates will be given you in the tax sheets that will be provided you in the exam. There are three types of income: non-saving, saving income, and dividend income. And there are three types of taxpayer. One is called the basic rate taxpayer, and in order to classify someone in this limit, the maximum limit is 33,500 of taxable income. If the total taxable income is up to 33,500, an individual will be classified as a basic rate taxpayer. And if the income exceeded from 33,500 and up to 1,50,000, that person is called the higher rate taxpayer. And if income exceeded from 1,50,000, then the person is called the additional rate taxpayer. And according to this classification, the rates vary from the income limit. And these are the income limit. For example, if a person is earning dividend and he's an additional rate taxpayer, then maximum tax on dividend is 38.5%, and maximum tax on non-saving income is 45%, and saving is 45%. As far as non-saving income, saving income is concerned, there is a special rate called nil rate band. Nil rate band means a portion of saving income is to be taxed at 0%. For example, if a person is earning saving income and he falls in the basic rate taxpayer limit, then first saving income of 1,000 is taxed at 0% rate. And if he is higher rate payer, then the nil rate band available is only for first 500 of saving income. As far as dividend is concerned, if a person is earning dividend, first 5,000 of dividend is always be taxed at 0%. that is first 5,000 of dividend income is tax exempted. And this is available for all taxpayer irrespective of his basic rate payer, higher rate payer, or additional rate payer. Now let's solve the examples using these tax rates and the income tax computation. Now, assuming that an individual non-saving income, that is net income, is 30,000. As it is a net income, so we have to deduct personal allowance from this, and there is no other source of income. So net income is 30,000. After deducting personal allowances of 11,500, taxable income is 28,500. Now, as the income is less than 33,500, so the taxpayer is classified as a basic rate taxpayer. And as this is a non-saving income, so first rate is 20%. So now the income is 28,500, the first rate is 20%, and the income tax liability is 5,700. Take another example. Non-saving income is 30,000 and saving income is 8,000. Calculate income tax liability. Now, as there are two components of income, so it's better to have a format. Non-saving income 30,000, saving income 8,000, total income is 38,000 before personal allowance. After deducting personal allowance, the saving income is 18,500 and the total income is 26,500. Now still the person is classified as a basic rate taxpayer as income is less than 33,500. First of all, we'll be taxing the non-saving income. The 18,500 multiplied by the first rate. This is the tax of non-saving income. Then, as it is a basic rate taxpayer, so he or she will get nil rate band facility. That is, first 1,000 is to be taxed at 0%, and afterwards the remaining saving income is to be taxed at the first rate, that is the 20%. So income tax liability is 5,100. Let's see another example. The non-saving income is 50,000, employment income. Saving income is 25,000, dividend income is 20,000. Calculate income tax liability. In this example, there are all forms of income is available. So let's see how we can compute income tax liability. First of all, put all these values in the format. Non-saving income 50,000, saving income 25,000, dividend income 20,000. So total of non-saving is 50, 25, 20,000, and total of all income is 95,000. Now, as the total of all income is 95,000, so we can classify this as higher rate taxpayer. So nil rate band would be different now. After deducting the personal allowance from non-saving income, it is the rule that we have to first deduct the personal allowance from non-saving income. The taxable non-saving income is now 38,500, 25,000 saving income, 20,000 dividend income. Now, the taxable income, the non-saving taxable income is greater than 33,500. Now, how to tax this income? First of all, the 33,500 is to be taxed at 20%, 66,700, and the first band has been completed. Now the remaining saving income, which is 5,000, is to be taxed at the higher rate that is available, 2,000. Total saving income has been calculated. Now saving income was 25,000. As the individual is higher rate taxpayer, so nil rate band is available on first 500 of saving income, not on 1,000. The remaining saving income, that is 25,000 minus 500, 24,500, is to be taxed at the second rate of saving income, that is 40%. And the dividend nil rate band is 5,000. So first 5,000 of dividend is always taxed at 0%, and the remaining dividend income, 20,000 minus 5,000, is taxed at the 32.5%. Why? Because the rate of dividend in the second category is 32.5%. So we will apply 32.5%, and the dividend tax on dividend is 4875. So total tax liability of this individual having saving income, non-saving income, and dividend income is 23,375.